Imagine walking into a bank with just $20 in your account. No one notices, no one cares, you're another number in the system. Now imagine walking into the same bank with $20,000 quietly sitting in your savings account. Nothing dramatic changes on the surface. The building looks the same. The teller smiles the same way. The app interface doesn't look any different. But behind the scenes something does change. Because $20,000 is not just a number. It's a psychological and financial threshold. It's the point where banks stop seeing you as background noise and start seeing you as someone who might leave. And banks don't fear small savers, they fear informed ones. This video is not about getting rich overnight. It's about what actually happens once you save $20,000, and why banks quietly start paying attention at that level. Most people believe banks make their money from wealthy elites or billionaires. That's a myth. Banks don't survive on millionaires. They survive on millions of ordinary people who don't question fees, interest rates, or fine print. The average customer keeps their money in a low-interest savings account, earning almost nothing, while the bank lends that same money out at much higher rates. That's the business model, so when someone barely has money saved, the bank isn't worried. You're not going anywhere. You're dependent. You need overdraft protection, short-term loans, credit cards. From the bank's perspective, that's perfect. But once you cross $20,000 in savings, something changes, not because $20,000 is huge, but because what it represents is dangerous. It represents control. At $20,000 saved, you're no longer living paycheck to paycheck. You're no longer forced to accept bad financial terms. You can wait, you can walk away, you can compare. And the moment a customer can compare, the bank's power weakens. This is why banks don't aggressively advertise high-yield savings accounts inside branches. This is why financial literacy is rarely promoted. This is why complicated fee structures exist. Confusion is profitable, clarity is not. Let's talk about interest rates. Most traditional savings accounts pay 0.01% to 0.1% interest per year. If you have $1,000 saved, the difference is meaningless. But with $20,000, that difference suddenly becomes visible. At 0.01%, you earn about $2 per year. At 4%, you earn $800 per year doing absolutely nothing. When people reach $20,000, many of them do the math for the first time. And when they do, they ask the most dangerous question a bank customer can ask: why is my money not growing? Once that question is asked, the relationship changes forever. High-yield savings accounts exist because banks compete with each other. But here's the truth they don't advertise: the money in your savings account is not sitting, it's being used. Banks lend it out as mortgages, car loans, business loans, and credit cards, often at 6%, 10%, even 20% interest. They pay you almost nothing, and keep the difference. When you're unaware, this system works smoothly. But when you have $20,000 saved, suddenly the gap becomes obvious. And people who see the gap don't stay silent. At this level, something else happens. You become marketable. Banks start sending pre-approved offers, better credit limits, relationship manager calls, exclusive savings products, not because they like you, but because they don't want you to leave. Customer churn. People moving their money is expensive for banks. Once you move your savings out, your checking account often follows, then your credit card, then your loans. One informed customer doesn't just cost deposits, it costs lifetime value. But here's the ironic part. Even at $20,000, most banks are still not treating you generously. They are still paying you less than the market rate, still charging fees, still betting that convenience will keep you loyal. And many people fall for it because money feels safe where it's familiar. Banks understand human psychology extremely well. They know fear of change is stronger than logic. This is why fintech companies and online banks became such a threat. They don't have fancy branches. They don't serve coffee. They don't offer emotional attachment. They offer numbers, clear interest rates, low fees, simple language, and guess who benefits most from that clarity? People with $20,000 or more. That's why many traditional banks either launched their own online arms or lobbied against fintechs. Because competition exposes inefficiency. Now let's talk about investments. At $20,000 saved, many people start asking another dangerous question: should I invest this? From a bank's perspective, this is even worse. Because when money moves into stocks, ETFs, or real estate, it leaves their balance sheet. Deposits are a bank's oxygen. Fewer deposits mean less money to lend, less leverage, less power. They sound safe. They keep money locked inside the bank's ecosystem. True investing, especially low-cost index funds, is rarely pushed inside branches. Because banks don't make much money from educated investors. There's also something emotional about crossing $20,000. It's not luxury money, it's security money. It means you can survive layoffs, medical emergencies, unexpected expenses. Security makes people less desperate. Desperation makes people profitable for banks. When you have no savings, you accept whatever financial terms are offered. When you have savings, you negotiate, and negotiation disrupts systems built on silence. Banks don't hate savers, they hate mobile savers. A customer with $20,000 who never moves their money is still profitable. But a customer who understands yield, inflation, and opportunity cost, that customer is unpredictable. Unpredictability is bad for large institutions. Let's talk about inflation for a moment. Most people don't realize that money sitting in low-interest accounts is slowly losing value. If inflation is 3% and your savings earn 0.1%, you're losing purchasing power every year. At $500, that loss is invisible. At $20,000, it becomes real. You don't need to be an economist to notice it. You just need awareness, and awareness changes behavior. At this stage, you start reading articles, watching videos like this, comparing rates. You stop being passive. That's why banks quietly track account balances, not to judge wealth, but to predict behavior. A customer with $20,000 is statistically more likely to move funds, refinance loans, or seek alternatives. And that's when banks start paying attention. But here's the truth no one tells you: banks won't educate you voluntarily. Financial literacy reduces profit margins. That's why you learn more from YouTube, blogs, and independent creators than from your local bank branch. The system doesn't break you, simply step outside of it. This doesn't mean banks are evil. Banks are businesses, they respond to incentives. The problem arises when customers don't understand those incentives. At $20,000, you're at the crossroads. You can remain comfortable, lazy, and predictable, or you can become intentional. The moment you understand that your money is an asset, not just a safety net, you start playing a different game. You compare interest rates the way banks compare customers. You think long-term. You stop being afraid of moving your money. Banks notice this shift even if you don't see it on the surface. And that's why $20,000 matters. Not because it's rich, but because it's awake. So if you've reached this stage, or you're working toward it, remember, the goal is not to fight banks. The goal is to stop being invisible. Money doesn't create power, understanding does. And $20,000 is often the point where understanding begins. If you found this breakdown useful, subscribe for more content that explains money without selling illusions. And remember, banks don't fear broke people, they fear people who know how money actually works.